Hello friends. Last week we saw the market scaling new highs, and as a matter of fact even the bank nifty for a change participated well. Now in this week's video I want to discuss whether the bears are likely to be dragged by their necks and forced to cover their shorts, which is called a bear squeeze or a short squeeze, especially since the coming week is an expiry week. When the markets went up, I told you last week it was all up to the US Federal Reserve and why the markets would definitely have a bullish kind of a tinge. Just remember what I said in this video up here, that 2024 is a special year because more than 5 dozen countries are going through elections, the biggest being USA on 5th of November 2024. Now, economic data would be gravy dressed. Promises of reform, tall promises, etc. You know the drill. That would give a feel-good factor to the global financial markets, and markets would more or less remain bullish. Now, let's dive right into our video and see whether the bears are likely to be forced to cover their shorts. Friends, on your screen right now is the weekly market roundup window, and what you're seeing is, for a change, it was the bank nifty which led the rally from the front, whereas the Nifty 50, the broader index of the two, brought up the rear. The US dollar index continued to slide and it's very precariously poised at the triple digit mark. And the weakness in the dollar resulted in a rally in bullion, and gold and silver both surged higher. Crude and natural gas went up due to cyclical reasons, also because of tensions in Gaza. Now, the Indian rupee vis-a-vis the US dollar witnessed signs of strength, and the Indian 10-year benchmark bond yield saw a 3 basis point dip in the yields, which means bond prices went higher, which is another one of those reasons why the bank nifty managed to outperform the Nifty 50. NSE market capitalization went up a little over 0.5%, which means the rally was somewhat broad-based. The MWPL or market-wide position limits went up routinely, although it does seem to be a little off compared to the commensurate week in the prior month. And the US headline indices all were up, thereby providing tailwinds to our domestic markets. Friends, I now come to the ratio chart between the Bank Nifty versus the Nifty 50, and you can compare any stock with any stock or index by simply typing the name of the stock you want to divide by another security with a slash and then the name of the second stock in tradingview.com. Now, the Bank Nifty versus the Nifty 50 is showing signs of strength, and it's a bullish power candle, and this is the second week in a row that the Bank Nifty has shown relative strength compared to the Nifty 50. Why is this important? Because of the weightage. Look at what's on your screen now. This is the updated weightage chart as on end of August. Now, financial sector services, including banks and NBFCs, etc., constitute 32.6% weightage in the Nifty 50. Now, without the banking and financial sector stocks participating in the rally, there can be no rally in the first place. So, we need the Bank Nifty versus the Nifty 50 ratio chart to climb above the 2.25, if not higher, if at all you want a sustainable upthrust, which is what we are looking forward to in the coming weeks as a sign of confirmation about whether the rally will sustain. Friends, I now come to our in-house indicators, starting with the MWPL, and the MWPL is at 43.28. Although it is above the 40% mark, but it is somewhat sluggish compared to the commensurate highs of last month. The reason being that the coming week being an expiry week, you are unlikely to see MWPL go up too much. So scaling that 44.79% which we saw pre-expiry in the August series is unlikely to repeat itself. Why would the market go up and why would the bears be forced to cover their shorts in a bear squeeze? I'll come to you in a bit. Now the MWPL shows a little bit of concern, a little bit of caution, but it's still above 43, which is telling you that retail risk appetite still remains optimistic. Now friends, I come to the stock and index futures turnover, and these are three concurrent series. So it's September, October, November. The turnover was higher, which means participation levels were good. They were improved, which is what we want. That's a good green flag. Now friends, I come to the advanced decline ratio. The Nifty has clocked somewhat smaller gains, but the advanced decline ratio has plummeted. It's fallen to 0.87, which tells you that for every 100 losing stocks, there were only 87 winning stocks. That tells you intraday spot segment buying conviction was somewhat lower as compared to the prior week, and this ratio, ideally speaking, should be above 1 with rising prices in order to suggest that the bulls are still gung-ho. Now friends, I come to the basis, and this is the crux of my argument that bulls will force the bears to cover their shorts in the days ahead before expiry. Now let's take a look at the chart here in front of you. What you see is a steep basis inversion on both the Nifty and more noticeably on the Bank Nifty. What is basis inversion? First of all, basis means the premium or discount prevalent in the future compared to spot, and inversion means invariably the future is trading below the spot, which means it's at a discount. Now the Nifty is witnessing futures trading at a discount of 23.20 and the Bank Nifty with a whopping discount of 242.35 rupees. Why does it indicate that bears will be forced to cover their shorts? Now you see, normally as a bear, you are paid to short sell by the very structure of the market because of the cost of carry, which is also called vyaj badla or rollover cost, finance cost, interest cost by certain traders. Now, when the next month futures basically are showing you a positive cost of carry and the current month futures are showing you a negative cost of carry, what you're basically doing is you're spooking the bears into saying, look, if you want to take your short positions forward to the next month, instead of receiving this cost of carry, we are going to force you into paying to go short. Now that takes the edge off from the expected profit of the bears. Right now, the cost of carry, which is the difference between September and October, is not half as bad as the basis is. But this is what the market is basically doing, is creating a kind of a fear in the bears that even the cost of carry could turn negative. Now that is one reason why either ahead of expiry you roll over your positions or you square them up. Typically speaking, shorts tend to get squared up more often than they tend to get rolled over. Very small percentage of shorts get rolled over. Now what you're doing is, by giving you a basis inversion, you're forcing the bears to cover their shorts, which means buy. That could create a flash in the pan kind of a sharp up move in the market. This is a possibility, and this is something that we need to watch out for in the days ahead.
Remember, in my last week's video, I had warned you that there was a serious disinformation protocol, or basically smoke screens being created in the market by trying to fool retail traders into taking positions that they ideally should not be taking. And this bear squeeze will be a part of that disinformation protocol, most probably.
Friends, I now come to our in-house indicator, the impetus. You've trusted it for 4 years now, and what you're seeing is that the rally in both the indices was accompanied by a rising impetus, which means there was greater force in the buying momentum, which is a good thing. Now, friends, I come to our in-house indicator, the lift, weight, thrust, drag indicator. The a tutorial video for this indicator is in the description and in the pinned comment below this video. So please familiarize yourself with what this indicator is all about. Now the Nifty might have clocked somewhat smaller gains last week as compared to the prior week, but the LWTD has fallen off a cliff from 0.40 to minus 0.14. That tells me that a fresh buying may not be very aggressive, but yes, short covering could cushion declines. Now, this fresh buying not coming in is also logical. Let's not forget it's an expiry week. So, what you're going to see is traders being more preoccupied with whether to roll over their positions or simply square them up. So, large, big ticket fresh buying is unlikely to be there, which is what the LWTD is indicating. Friends, my in-house indicators done. I now come to the bond markets, which is at the crux of our analysis, because this market funds the prices of all the other asset classes. Now, the bond yields continued to go lower, and last week also we saw Indian benchmark bond yields fall by 3 basis points, which means bond prices are up. I told you a couple of weeks ago in our weekly video that 6.75, give or take, 6.75 is a ballpark level to watch out for. This is where I think the Indian bond yield is more or less settling down. Now, as long as it's here, it's in no man's land as far as I'm concerned. It doesn't offer me too much by way of potential profit on the table from gilt funds, and definitely having kind of laddered the sovereign yield up to 7.5% almost 2 years ago. Deploying fresh funds at 6.75% makes no real gain for me here. So I'm keeping the powder dry. I'm staying off gilts and sovereign bonds as of now. As and when I do, I will update it on our free Telegram channel and our free new WhatsApp channel. The details and contact coordinates to these channels are in the pinned comment and description below this video. Friends, the bond market's done. I now come to the Bank Nifty, which led the way upwards. And as you can see on the daily chart on your screen, this index has risen on 5 out of 5 trading sessions. It's at an all-time high. Finally, it's caught up with the Nifty 50 and clocked a new high. The price is above its month-long moving average, which itself is turning upwards, and it is also broken out upwards above the bullish wedge. All in all, the short-term outlook is positive as of now because bulls seem to be having an upper hand. Take a look at the weekly chart on your screen, and that shows you that last week's rally was accompanied by a bullish power candle. Power candle is a large size candle which is somewhat bigger than the recent candles that were formed. So it's definitely a noticeably large candle. It's a power candle. Price is comfortably above its 25-week exponential moving average. That's a proxy for a 6-month-long holding on cost of an average bull. So here again, the medium-term outlook is also positive as of now. As long as the Bank Nifty manages to close above 53,700 sustainably on a day-on-day basis, bulls have an upper hand. Now, do remember what I told you here in this graphic about the weightages. At a 32.6% weightage, banking and financial sector stocks have a huge sway or a swing in the Nifty itself. So there can be no sustainable broad-based rally without the banking sector rallying itself. Friends, in the week before last, this index was at number 5 on the most volatile counters list as per statistical beta rankings that I maintain in-house. It rose by 1 notch to number 4, which means challenge level for the retail investor trader went up marginally. Last week, I advocated an estimated range between 53,500 on the upside and 50,350 on the downside. I went wrong by 566 points because the high it made was 54,066 levels. Now, in the coming week, I estimate a range between 55,275 on the upside and 52,300 on the downside. Friends, in addition to these levels, please also check out our daily, weekly, and monthly pivots on our free Telegram and WhatsApp channels, and laser precise your entry and exits in your futures and option trades. Friends, the Bank Nifty done. I now come to the Nifty 50, which brought up the rear by rising 1.71% on a week-on-week basis. And as you can see on the daily chart on your screen right now, it rose on 4 out of 5 trading sessions. Also clocked a new all-time high. The price is comfortably above its month-long moving average, which itself is trending higher. So the short-term outlook is positive. And since this index, as is the case with Bank Nifty, is in blue sky zone, which means new highs, there is no overhead supply which is likely. Now, overhead supply is a concept where traders who bought at higher levels and have got trapped by a market decline after they bought, coming out to sell at break-even points. That is overhead supply. Now, since this is at an all-time high, no overhead supply is likely. Now, let's take a look at the weekly chart. It's a bullish candle, but admittedly, the candle size is smaller than last week because the thunder was all in the Bank Nifty. The price is above its 25-week exponential moving average, which is a proxy for 6-month-long holding on cost of an average bull. So the medium-term outlook is positive. However, the price is way higher than the 25-week average. So some amount of consolidation or even a small correction, even if it is a time-wise correction, is an open possibility. This index must stay above the 25,700 levels on a daily closing basis for the bulls to retain their advantage. Friends, in the week before last, this index was number 9 on our most volatile counters list. It fell by 1 notch to number 10, which means the challenge levels went down marginally for a retail trader. Last week, I advocated an estimated range between 25,950 on the upside and 24,750 on the downside, which held perfectly well in spite of all that volatility. In the coming week, I estimate a range between 26,375 on the upside and 25,225 on the downside. In addition to these levels, also note our daily, weekly, monthly pivots on our free online channels. Friends, I now come to the last bit of statistical analysis in this video, wherein I gauge the retail risk appetite by their footprint and participation in the 4 derivative segments last week. Index futures turnover contribution went up by 2 basis points. It's indicated as a blue line. Stock futures turnover contribution went up by 10 basis points. It's indicated as a red line. The index options contribution went down by 69 basis points, and that is indicated as a green line. Stock options contribution went up by 57 basis points, is indicated as a purple line. Net, I would say that risk appetite was higher. Now, you could argue that turnover in the futures segment is higher because of rollover. Yes, that's right. If trades are getting rolled over, there is turnover in the current month series and the turnover in the next month series, which is why the turnover appears higher. But the fact remains that if trades are getting rolled over, that itself is a sign of increased participation and risk appetite. So net, traders are showing a reasonable amount of confidence in the market. Friends, I now come to my own weekly strategy, and as far as I'm concerned, I will trade light with a small trade size, because I've explained to you in this video how you can make higher amounts of profit per trade even by keeping your trade small. Let's not forget, it's an expiry week. Volatility is likely to be far higher than normal. Now, as far as sectors are concerned, my prima donna and prime focus will be on public sector undertakings. And within the PSU space also, it will be public sector banks, oil marketing companies, defense, energy, and power stocks. Now, these segments of the market will provide large two-way price moves for savvy traders. And therefore, if you're used to taking higher volatility spreads into your daily trades, you might be better off trading on these counters. In the commodity markets, base or industrial metals saw some resistance at higher levels, which means metal mining companies' shares will see higher than average volatility in the week ahead. So traders might just want to watch these stocks as well. Bullion remains a long term investment story as long as you ignore the short term volatility that is inevitable and unavoidable in the calendar year 2024. Look beyond 2024, the longer the better, and better days ahead for bullion investors. Now, these are videos that I have recorded on the outlook on bullion, how to buy bullion at reasonable prices, not to get cheated by buying impure gold and silver, how and where to basically buy bullion, in which form, at low cost and cost effective prices. Do watch these videos, please. All the videos that I want you to watch are hyperlinked in the description below this video as well as in the pinned comment below. My energy trading blueprint is on track and remains unchanged. The seasonal and cyclical price movements are at play. The Gaza war is adding grist to the mill by raising concerns on supply chains, and therefore prices are rising along expected line. But this, like I said, is a cyclical rally till the US hurricane season, especially for natural gas. It might extend to the end of winter. This is something that I've written lots and lots often on my Telegram channel if you'd bother to search those articles there. Now, I'm sticking to theta decay strategy for now in the non-linear segment because we are likely to see expiry of natural gas as well in this week. And I would, like I said, want to maintain Hacienda hedges or tail risk hedges. I've explained what tail risk hedges are in this video. Do make it a point to watch this video as well. Before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know how my videos are helping you become a better trader and what you would want me to record next. Also, hey, a request. Please share my videos with smart friends and traders like yourselves on your social media platforms, WhatsApp, Twitter, LinkedIn, Facebook, etc., so I can reach out to a wider audience and help people trade better. I thank you for your patience and being with me in this video. Till we meet again in my next, this is Vijay signing off for now. Have a very, very profitable week ahead. Take care. Bye-bye.